Welcome to Upside, where we dig into the real stories that live behind the headlines affecting European venture. Today, it's Mads, Lomax, and my good self, and we're talking about big tech earnings blowouts. We've got, is SaaS back? Liberation Day 2.0. Actually, at time of recording, it's the morning of Friday the 1st, which is Trump's new Liberation Day. We know the EU-US trade deal has happened and some other bits have going on, but hopefully we haven't missed too much. Can the EU fulfill its trade deal with the US? We'll talk about that. We've got a mega AI corner today and Project Europe. Is it what Europe needs? So cracking straight in, topic one, big tech blowout, massive earnings this week. We've got Meta and Microsoft just posted. Amazon posted last night as we were chatting. So surprising, stunning Q2 earnings that sent stocks soaring. Meta up 10%, Microsoft up 9%. Amazon, Lomax, I'm going to lean on you for some Amazon numbers because I know you've got those, but that's happening as we speak. We won't talk about Apple earnings disclosed as we were recording again. I'm not sure if anyone knows what's going on there, but they're just quietly milking the cow in iOS corner, so we can probably ignore them. But back to the big headline numbers. Mads, what the hell's going on? Meta revenue up 22% to 47.5 billion. Microsoft 76 billion, up 18%. These are mega numbers. What's going on here?
It's incredible. So all the Mag7 companies have now delivered Q2 earnings, bar NVIDIA. They have a sort of a different quarterly cycle from everybody else. Clear winners here: Meta, Microsoft, Apple, and Google have been powering ahead. Middle of the road, Amazon disappointed a bit. Clear loser, Tesla. They're just not firing on anything right now. But if you sort of go back to some of those winners you talked about, so Meta up a lot, 22% year on year, but net income really powering ahead, up 36%. And they should say the stock had a massive bump because they outperformed expectations. Microsoft also doing really well. Both companies are seeing an AI drive in real time, so real revenue growth and margin expansion for slightly different reasons. As we know, Microsoft has got a massive cloud business, and that cloud business is growing and growing super fast. Now, $13 billion run rate that they attribute to AI alone. That's things like CoPilot is their Azure AI tokens they're selling. And Meta, on the other hand, not selling AI technology on a B2B basis, but instead using AI to transform their own business. And the efficiency revolution they've gone through over the last few years is nothing short of staggering. They cut their workforce by 17% since 2022, since they had that whole get fit moment. And the revenue trajectory since they started that sort of cutting back of headcount has said 116 billion in 22, 135 in 23, 164 in 24, and they're now at $190 billion run rate. Okay, so from 22 to 25, they got from 116 to 190. It's staggering. I mean, these are not millions, it's billions of dollars. Okay, so 63% revenue growth with 17% fewer people. And that's really this efficiency drive and all the things they've been able to eke out with AI.
That accounts for the bottom line at Meta. But what about top line? So if you look at, we talked about the top line growing in the B2B category. What's growing, accounting for the top line growth at Meta? Is it this the efficiency drive not only is on headcount numbers, it's also making, user acquisition more efficient, or advertising revenue makes it more, like, what do you think is driving the top line?
Ads are a lot more efficient, and they're really able to eat a lot more out of them. So the two things they're doing is they're able to get people to use the apps more. People can have various opinions on that. And obviously that's a bit of an asymptotic game they're playing because there are only so many people on the planet. Most of them are already, a very high proportion are already using Meta products. And there's only 24 hours in a day. Some of us are not, sitting on Instagram every day, but we know that the people that are, they've had, several percentage points increase in the amount of time they've spent on things like Instagram and Facebook every day with fewer employees managing the systems.
So I cut Mads off in his stride, but I was just very interested in that point because it's slightly different to what's going on across enterprise AI.
It's super interesting, and I think maybe under the covers this sort of explains why Zucky's been so bullish about some of the AI investments he's made in Q2, because we've seen him go absolutely bananas with offering $100 million for AI specialists to come and join him. And I think knowing,
I thought it was $1 billion, Mads.
possibly, I mean, it's just,
Wasn't there a $1 billion package?
It can't be true, right? It can't be. I don't
For
believe
one
it.
person. No.
But when the case is, these are staggering numbers for to bring talent to your business. And I think because he knows the underlying company is performing so well on one hand, but on the other hand also that Meta's got this existential issue of where's the business going to go from here, and he has to get back in the AI game, not just in terms of improving his own internal business, but actually having things that are compelling from an external perspective as well. We know they were quick out of the gate with open sourcing around Llama. We also know they've fallen behind, for example, some of the Chinese frontier labs. So a lot of exciting moves there.
I always wondered if they'll have a name change because he was so bullish on Metaverse, changing the name to Meta. This is only 22, it's only 3 years ago. So it's such a quick, and he's always so quick to double down and go so bullish in these mega AI specialist deals. And I was looking at the guy that's leading I can't remember the chap's name. I think it's Alexander something. He looks like 22. And he's got this mega package and he's running the AI department. So, well, good for them. Let's see what happens. But Lomax, justified? Is this real? What's the scoop behind?
Well, just on that, before that though, I think this week doing the rounds was a presentation that Zuck gave 10 years ago at one of the Facebook AGMs, which is fascinating reading, and it pretty much vindicates like all of the predictions that he had, for the business. So, per your point, it's very the guy seems to, see around corners in a way that other people don't, and he keeps doing it. Fascinating.
But Metaverse, massive fail, right?
I don't know, man. I think like if you're looking at the next form factor beyond the iPhone, Zuck may be looking right around the corner in the right way. I mean, the deals he's doing with Ray-Bans, the glasses, moving to a mixed reality world. I know you're not necessarily the most bullish.
No, I
on
don't.
that,
I don't
but
believe.
wait for that.
I don't believe that'll be I don't believe a form factor that lives between humans will last. I was absolutely blown away by the Ray-Ban numbers. I couldn't believe how many units were sold, and I think there is utility, but I think it will very soon be drawware. And I don't believe that in any form factor that lives between human beings. I don't buy it for a second. But I do believe there is some utility, like there is utility even with Apple's face pods. There is a utility, but I just don't believe it's going to be the form factor. I'd be intrigued to see what Johnny Ive and Sam Altman come up with, whether it's a pendant or another set of glasses or a watch or another thing. But I didn't mean to interrupt you, but no, I don't buy the glasses.
I will. Okay, I mean, he made a bet. I mean, Oculus is still like selling units. Like the install base of Oculus is actually surprisingly high when you look into it. Okay, Metaverse had its moment. It will have another moment, I guarantee you. And I think we're moving. AR is something that will be very, very interesting going forwards. Anyway, back to your question. Despite high interest rates, sticky inflation, and billions in AI capex, they're actually, the numbers here are phenomenal, as Mads just said. So the earnings growth is substantial, and these are not, the multiples are actually not crazy. Meta is trading at 26 to 28 times trading price to earnings. Still, like that's a pretty modest multiple considering its cash flow and growth profile, and its 10-year average of actually trading at 30 times. So it's actually trading below where it's traded in the past, which is pretty phenomenal.
No Palantir, is it?
No. So Microsoft is up near 40. So that's near decade highs. And that's telling you that the AI mania is exaggerating premiums. But, and what we said at the beginning of the year when we were talking about this is it takes one earnings miss to take a lot of the heat out of this. But that hasn't happened yet. By the way, NVIDIA will be reporting in August. So we'll see, but I see no reason why they would be missing. So actually, Meta is trading at quite a sort of sensible-ish number. Microsoft looking quite toppy, but the numbers are there. Mads just took us through them. Unlike a lot of tech booms that we've been through, and we'll talk about in a minute, another sort of big IPO that, not one IPO for a deep tech company. Like these are not companies trading at, hundreds of crazy multiples, These are like mature, solid, cash generating businesses. It's fascinating to see.
But Mads, they have I mean, both Meta and Microsoft have upped their AI capex for 25, I think. So is this real? What give us the insight on the spend part and how that's going to play forwards.
The numbers are, I don't know, exciting, scary, kind of however you think of them. So Meta is now planning between 66 and $72 billion in AI capex for 2025. And for context, the entire European venture ecosystem is less than 60 billion. Okay, so it's just, it sort of puts things into perspective.
That's context.
You know, Microsoft, their AI business, as I said earlier, there's already at a $13 billion run rate. Interestingly, the company that's leading really into capex is Amazon, that behemoth of kind of things in the physical world, right? And they sort of gave guidance of up to 100 billion in capex spend. And the challenge they have is they're now seen as a little bit behind in the AI race. They don't have their own LLM. The AI business has not grown to the extent Microsoft SaaS. They're losing share in cloud. So the business is still growing 18%. The cloud business, AWS, growing 18%, which is a nice number standalone. But Google and Microsoft are growing plus 30%.
It's a bigger business, Matt. So clearly, you know, it's the growth rate is a harder one to get. You know what I mean?
They're losing share.
It's a bigger number.
They're losing share, and they're not gaining as fast, especially in the AI segment, as Microsoft is. So people are saying, look, 100 bill of capex on one side, you're spending like a growth company, but you're growing like a mature company, and that is why the stock got stick after that forecast, after that guidance.
Two questions I want to put to the room. One is the reality of this. So Fed stuck fast on interest rates this week. We'll see what happens in September, because there's already dissension in the ranks within the Fed and people voting against keeping rates the same. There's two, I think, Trump appointees in the pot that are now starting to make a play for dropping rates.
Well, inflation's going up.
The inflation in the States is still
quite
going
up. It's going up.
Is it? So I think it was 2.1 headline rate. The last time I saw but it's on. Maybe it's ticking up. I'm assuming there will be tariff impacts at some point. There just has to be. Question one is around that the reality piece, and then if somebody can then bring it back to Europe, and then how is this going to come back and flow into European valuations and European reality? Mad, maybe you can kick off.
Oh gosh, but we're connecting so many dots here. I mean, just taking it step by step. Yes, US inflation is going up. I think we're about 2.9% now, so it's likely we'll see a 3 handle soon.
Are we?
And what's happened is, since the Fed started started loosening rates, right, started reducing rates last year, we've actually seen the 10-year, if not go up, then at least stay flat. So kind of the Fed's guidance has come down, but the rates are staying up, because there is this conundrum where people are saying, look, inflation is here and it's being sticky. I think the reason why stock markets are still so bullish, and this is a big question, right? If inflation is high, rates are not coming down, how can stocks be so bullish? Well, it's back to AI. Everybody is looking at these incredible blowout numbers we're seeing from the Mag7 companies, and pairing that with the potential of AI, right? Because we're still only scratching the surface. We're already making so much money. We're still only scratching the surface. This is nothing like the dot-com era, right? There's real numbers, amazing profit margins today. And that's why there's all that excitement around stocks. Now, how does this link back to Europe? I think to answer that, we really have to look at what's happened with trade.
You know, the historical reasons that we have behind the inflationary environment that we have are, as far as I can tell, unconnected to AI, right? Like they are not correlated. I wonder in the future whether there may be some convergence and they have more interplay into each other, especially when you start to see the impacts of AI on the economy and productivity and, you know, et cetera, et cetera. So and jobs losses, because if it starts to move, then, you know, that will affect pricing, which inflects, you know, inflation. So, but historically, uncorrelated.
There are so many moving parts here. That the main ones obviously being AI, tariffs. I mean, the market is more than just the Mag7, and everywhere you look, people are waiting for the next crash or some kind of market correction. But the fundamental numbers that live behind the hype for many of these companies seem to be in the realistic bucket rather than the more beyond the crazy hypey bucket. So there's so many.
This isn't 2021, no, or even 2001, no.
But let's take the counterpoint for a minute, because I think investors are looking at, you know, first of all, there are the companies that are doing incredibly well just because AI, right? So NVIDIA, world's most valuable company, clearly That's who they are. Then are the companies that are using AI to their benefit, the Googles, the Metas of this world, and to some extent also the Microsofts, right? Incredible businesses, and especially Google and Meta have really shown what AI can do to transform a business and be more efficient. And I think people are extrapolating and saying, look, clearly these are bellwether companies, not just in tech, but for the world. The most sophisticated of the most sophisticated. Now, if we can see the same level of efficiency gains on Main Street as we are seeing at these incredible Mag7 companies, what will that transform into in terms of efficiency, in terms of increased earnings for corporate America? That is a staggering potential. Now, Lomax, granted, all kinds of challenges along the way. And I think right now people are just saying, not hearing it, right? Not believing it. This is going to be amazing.
That kind of then begs the question, are these efficiencies back office or engineering? I know this is a bit of a blunt way of looking at it, but is big tech able to eat its own dog food because a large part of its capex or its spend is in the engineering department, and that's where the efficiencies are? So the question for you, Maz, is what can transfer to Main Street?
I would sort of link back to our own investment thesis, which is very much about physical AI. To some extent, a lot of the things we are automating are still the easy bits. It's the stuff in the data center. It's the stuff that's got lots of well-structured data, right? We started with banking transactions and travel reservations, and then we went to retail and e-commerce, and now online advertising, optimizing who plays ads where, and who gets served what. It's still all the stuff with all the good data, all the stuff with messy data in logistics, in supply chain. We know it's largely unautomated, but we also know it's possible now, and that is what will hit Main Street, and it will be completely transformative.
I agree with you. Dan, you asked about Europe. One of the things I reflect on is that every quarter that you see these outrageous numbers pulled out of the ground by Mag7, it's almost like another glaring reminder of how behind a niche like Europe is. Like, as in, we can talk about SAP, we can talk about ASML, but there isn't much else we can talk about, really. I mean, we've been talking about defense companies recently, but let's just park that for now. They're not necessarily tech companies. So I think, I'm afraid, it's a stark, staggering reminder of the gap between the two geographies. It's just shocking, really.
We are good at talking ourselves down. I think it's sometimes easy to remember, easy to forget, if you will, that we are some years behind. I think we're seeing amazing things on the ground. I think we're talking about a number of incredible European tech companies today. Also, some that are competing in spaces that traditionally would have been reserved for Silicon Valley. So yes, I agree with you. At the face of it, we are far behind. And we've talked about the wake-up call. We're going to talk about US and EU trade. There's a lot to do, but I wouldn't say that all is lost for sure. I think there's a lot of kind of green shoots that we just need to nurture, and then they will become big and successful companies.
Yeah, for sure. Otherwise, we would definitely have to change the name of this podcast.
But are you in the market for downside?
Yeah, let's not go there.
I'm the bogeyman here. Yeah. Okay.
No, play the counter. I think there's two sides to it. One is, where can we play on the same playing field as the Yanks? And let's not dismiss the Chinese, a whole podcast for another time. And then where can we absolutely lean in at the application layer? And Mads, as you were saying, where and how this transfers into Main Street, I think, is going to be extremely exciting. So lots to play for. Staying with markets, Figma is SaaS back, blockbuster debut, IPO city. Mads, take this one away for us.
So I think most of us know Figma. It's a wonderful, SaaS company that produces some really, really brilliant design applications, web serve, a big competitor of Adobe, almost acquired by Adobe a few years ago for that $20 billion acquisition. It was turned down by antitrust authorities. Basically, both UK, EU, and the US said, look, if Adobe is allowed to buy Figma, they will get too much of a stranglehold on the market. Deal was blocked. Figma got the breakup fee, went back to business, and then really executed really well on talent retention and continuing to build, and just IPO'd yesterday. And what an IPO. Essentially, they IPO'd at a share price that was quite similar to what they would have gotten in the acquisition by Adobe. So $33 a share, sort of just about the $20 billion mark, give or take. But on the first day, the stock absolutely popped, closed up at 115. That's a 2.5 times pop in less than 24 hours. And so went from a $19 to $20 billion valuation to about $65 billion in the first day of trading. It's the largest first day pop in more than 3 decades for a US company raising more than $1 billion. And so is, SaaS back? I think there's certainly some excitement today saying that it could be.
Well, I think we also have to have a section in one of our podcasts talking about what SaaS is and AI pricing models and how that's all unfolding. So I think that's an interesting topic.
Haven't the bankers mispriced this, Mads? Haven't, if you're an existing shareholder of the company, clearly you're not complaining if you held your shares, right?
You have to.
But
look, there's a lot of talk about mispricing. Okay, so they raised about $1 billion. And so you're absolutely right. They raised about $1 billion and they could have gotten about 3 or 2, about 3 instead, right? And for the same dilution. But they're all the investors have lockup. They still have their shares. So yes, true. The bankers probably underpriced it, but I also think, folks that are saying that investors are leaving a lot of money on the table. I mean, it's a 5% dilution. I don't know. I think you folks are stressing about the wrong thing there.
Well, there are some fairly strong fundamentals, right? So, Mads, give us those. And
I mean, it's pure enterprise software. It's $1 billion revenue. It's growing about 40% per annum. The business, people look at the business and saying this is an amazing company, 91% gross margins, 132% net dollar retention. So land and expand is really working perfectly in with nearly 80% of Forbes 2,000 customers. So very, very deep enterprise penetration. Dylan Field, the founder, the CEO, he started the company at 20 and he's now 33. So his patience has really been rewarded, right?
He did the Peter Thiel Fellowship. No, in fact, it's probably the most successful company to come out of that fellowship. Yeah.
Was that where it came from? I didn't know that.
Yeah.
Who were who were the investors? Who are the winners?
Well, it's the usual big names. I mean, it's like time and time again, and LPs sort of roll this out on LinkedIn almost every week, talking about you have to be only in the big names because their names turn up time and time again in all the big companies, which we know is sort of largely true at the big fund level. So. You got the usual suspects, Kleiner, A16Z, but I think, interestingly for Europe, the biggest shareholder was Index.
I was just about to say, Index must be in this one.
I know.
No.
No, Index. So Index was the biggest. And so I think that's great to see. And they're going to make out like absolute bandits here. I think they had a 17% stake in the company, which also the ownership is just phenomenal that they had managed to retain in this company. Listing day stock, Mad says they are subject to lockups, of course, so they won't have liquidated this yet, but saw their listing day pop, saw their stock rise to $7 billion. I looked into it. So Index have they've raised $15 billion total in their whole life since 1995, right? Over 30 years. They were also a big shareholder, drum roll, in Wiz, the $33 billion exit that happened earlier this year. So I think they probably, took $3 to $4 billion out of that, owning 10% of the company. So actually in those 2 transactions in H1 this year, or just after H1, they've taken, let's call it $11 billion. They've raised $15 billion in the total life of the firm. It shows the sort of power law numbers in venture in terms of the importance and reliance on a few number of big assets. Obviously, Index seem to be doing it over and over again, which is very, very impressive. And so actually having just played the bogeyman on the Europeans in the last segment, I can kind of be more of a cheerleader here because I think this is vacillating. And then one more thing I would say is, do you remember Mads talked about the aborted acquisition? Then obviously there was that, I think that was at 20 billion, right, Mads? Yeah. The actual acquisition that Adobe was going to buy the company. In May 24, they did a tender offer for employees. So 650 to 700 million was put aside to buy shares from employees at 12 billion to basically reboost morale after the aborted exit. Interestingly, that looked like a good deal at the time. It now, a year and a half later, looks cheap. So if you're an employee and you sold at 12.5 billion, you probably weren't complaining at the time. You might, with hindsight, realize you might have left a bit of money on the table there.
Oh, Well, to be fair, I'm sure they're not complaining. Mads, what does this mean signal wise? Is SaaS back? IPOs back? Or is this just a one-off?
It's such a quality company, and of course there aren't many companies that are as good as Figma. And so the big question, I guess, you're asking is, well, if you're just a little bit less great, could you still make it out? Can you still get these kind of results? Parallel to some of the other things, we might talk about, which is the Anthropic raising right now. I think we're going to touch on that at $170 billion. Well, it looks like that's just about 30 times revenue, whereas actually markets are now pricing Figma up to about 60 times revenue. That looks a little bit overbought, but it does say that perhaps public markets are not being as Ebenezery as we thought they might. Sort of for a couple of years, we've been talking about how kind of private markets are just go, 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 and valuations overinflated. And then there's the reality of public markets, and companies are trading much lower. And, it's kind of the day of reckoning and all that stuff. And I think we sort of as an industry maybe allowed ourselves to be talked into believing that we should keep all these assets private because the public markets weren't paying up anyway. Well, Figma sort of puts that a little bit to bed. And one can hope that the outcome of this is that many more boards and founders will say, do you know what, let's accelerate that IPO trajectory so we can get these companies out, clear the backlog, and recycle capital back into the next generation of companies.
There's so much liquidity trapped in private markets, a lot in private equity, but a load in venture capital, that this needs to be recycled. It needs to come out. And it's actually, Europe this year recorded the lowest amount of funding going into venture funds in the last decade, right? We saw that in the H1 numbers. So, and the situation in the US is not dissimilar. So the liquidity needs to start flowing back, and you need results such as this. Interesting comparing it to Anthropic. I mean, it's interesting when you compare the numbers. The growth rate at Anthropic is clearly insane, having gone, basically added $1 billion a month over the last few months to the top line. But the gross margin at the moment we know is probably sub 50% or around 50%, whereas you've got Dylan Field's company, Figma, growing at a more modest, like 40, 50% per annum, but, is operating at a 90% SaaS margin, has all of its unit economics sorted, and, is a sort of much more mature company in a way. But it's interesting to see the kind of comparison between one, in AI, we're still in sandbox, even though the numbers are crazy, we're still in sandbox mode in a way. We're still learning where this is all going to shake out. Whereas, Figma has become like, at the moment, it's the archetype of where the SaaS industry is at today. Just on IPOs, it's interesting this week that to move to the more funky end of the spectrum, Firefly have launched which is a space launch company, have launched their roadshow for their IPO targeting a $5 billion NASDAQ listing, $5 billion valuation. Interesting to see, because you may recall in the last few years, we had this sort of deathbed or graveyard of space SPACs, Astra, Virgin Orbit, Virgin Galactic, Momentous, Black Sky, all ended up, going down the pan. You can see the exuberance in the market now, where you've got Firefly, which did 65 million in revenue last year, now targeting a 5 billion valuation. Now, this is a launch company. They actually were the first private company ever to land a lander on the moon this year. So they're clearly doing impressive things. But we're now back in, this is the territory of, I have a 5 billion valuation, but I haven't got any revenue yet, basically. So it's like, it's the opposite of what's going on at Figma, which is very fundamentals driven.
Let's talk about we can't not talk about the EU-US trade deal. I have so many questions about this. As we're talking about big tech and we're all celebrating these massive earnings, obviously Europe is staring down a different barrel of a different gun. So the EU-US trade deal was announced this week. It's Friday at the time of recording. I think it was Wednesday, Tuesday perhaps, but we had, these were the outcomes. So 15% uniform tax on most EU goods, down from the 30 as was threatened from August 1st, which is today, to recording. There is an exemptions list. It's quite long. I'm not going to go into those, but steel and aluminium does stay at 50%, although it has a quota system. So there are some trade that can go on underneath that. Now, here's the funky bit that really got me pondering how the mechanism is even going to work. So the EU has committed to purchasing $750 billion of US energy, and EU and companies within the EU will invest $600 billion into US manufacturing. etc., etc. There are also items on the table around significant purchasing of US military equipment, and there are various other measures which look pretty anti-China-esque if you scratch a little bit on the surface. Now, this deal is a framework, needs to be ratified by all member states, and some of the reactions to it have been irritable, frustrated, embarrassment. We've got Nicholas Osberg from Delivery Hero, who tweeted this week that he's embarrassed to be European about the terms. Personally, I just can't see how the EU can force companies to behave like this, or where this money is going to come from, or how this mechanism is going to work. Obviously, I'm not an EU buying procurement specialist. And I'm also looking at the Japanese deal. I'm wondering how they're going to find $650 billion and what they're going to do. So what am I missing? Mads, maybe you can kick off, walk us through what's real. What did Europe give up? Where did we roll over? It feels like we did. What's happening?
To some extent, you could say the foundation for this deal was laid not, with Trump's election victory, but kind of over the last several decades as Europe decided that we no longer needed to pay for our own defense and outsource that to the United States. That saved us, call it 1% to 2% of GDP per annum in not having to make that defense spending. There was always that discussion going back to sort of the noughties around, where the peace dividend is going to come from. And, some people would say, well, we've been collecting that forever because really for so many years, we've just been relying on US military supremacy. And so you could say the bill has now come due. We outsourced defense in the past, meaning we can no longer defend ourselves. Ukraine is a huge mess, and we know we're absolutely reliant on the United States to continue to stand up to the Russian aggression there, and therefore unable to defend Ukraine alone. And dependent on the US, we have to submit to their trade terms. And in the context of that, you could say 15% might be getting away quite cheaply. Obviously, it would have been better not to have it. There will be a bill to pay, not just for European business, but also for US consumers. Certainly in the short term, it will have some inflationary pressure. We've already seen the July data showing that some of the import-intensive categories are leading the price increases. Core goods inflation is up, and it would be up even further if it wasn't for some of the order price changes we've seen, where people have been running down inventories as opposed to actually importing with the bigger tariff. So yeah, lots to unpack. And I think we probably are, at the end of the day, we probably made this bet ourselves, and this is where we are. Now we can talk about all the things we can now get out of it, but I'm sure you're going to come on to that.
Yeah. Well, let's start with winners and losers, Lomax. How does this break down in reality?
I think there's two ways of looking at it. I mean, as Matt says, so this is the biggest trading block relationship in the world, right? It matters for both blocks, clearly, and the people who live within them. It's quite clear that if we want access to the biggest economy in the world, these are the terms, like it's sort of, we could choose not to have access to it, or we could choose to have access to it at higher prices with the 30% tariffs. This is the deal that's shaken out. I think I think Trump's done a good deal here. I think Europe's a bit on the back foot. There's a bit of an irony here that we've all been talking about the European sovereignty angle in the last 12 months, how Europe now needs to invest its own defense, core capabilities, infrastructure. Yet here we are having a gun put to our heads and being made to buy, more US defense supplies. And we've seen that when you become reliant on a supplier, you become reliant on the upgrades, you become reliant on everything, and then they could shut your operating system off mid-flight. So, the whole point, literally, of the narrative in Europe in the last 12 months has been, how do we build sovereignty in our defense supply chains? One of them is, owning your own critical infrastructure and technology. And suddenly we're now, it's shocking to me. And I hope it's clear that defense is not just a sideshow here. It's not a 2, 3, 4, 5% of GDP, because it underwrites the democratic system in which we live. It's incredibly important because many, many things flow from that. I think we've seen the importance of that in the last few years. So you just take that as an example. So we talk about European sovereignty. We do a deal where we actually give it away in some respects. I think Trump's played a blinder here. He's procured $600 billion of investment from the EU into his manufacturing capabilities. I mean, yeah, we'll see how that plays out. But we're sitting here complaining every week about the lack of money that goes into our own companies. So suddenly someone's got to find 600 billion to go. So actually for startups, don't forget software, of course, is not captured by this. This is goods. So hardware startups will have to, will be hit by the tariffs. But I think, in a way, for European startups and scale-ups, one message could just be, particularly if you're software, like heads down and build. But at the same time, it's like, well, you look at all of this funding, which will now go to the US. I think the US is the winner here.
What's the reality? I know no one will know, but what's our opinions? Mads, chime in as well. What's our opinions on what's the reality of what will move to the US, what will be invested in the US? Lomax, I don't know if you've got any thoughts on that.
No, I mean, often these things, it's about the PR and the news statement on the day is trumps everything, so is the most important thing. So stuff always gets watered down out the back end. But still, if you sign an agreement with the US promising to make these investments, like, they're gonna, especially this administration, they're gonna hold you to account for it.
I reckon this is a delay tactic. I reckon he's got 3 more years in tenure. I reckon this is just a delay tactic. Keep him happy. Sure, we're gonna do it. Mads, is that
I think
real?
there's something to that. Clearly the alternative was untenable. The German automotive sector looked at 30% tariff, which was the alternative, and said, no way, it's unaffordable. 50% is not nice, but we can deal with it. And so, yeah, there's probably a hope that when this current administration passes on and passes the torch to the next, that some of this could be ameliorated a bit.
I mean, Lomax, you've seen a bunch of cycles around this, as we all have. What's the context here? Do you know? Didn't we come from 10% tariffs each way before the 30% threat and then the settle at 15? What's been the EU-US arrangement in the past?
I personally think the actual tariff number is not shocking and something we can live with, and I wouldn't get too heated around the 15% number. I think, yeah, you take it in the historical context. When if you go back 100 years, tariffs were way higher and obviously a massive driver of revenue for the US government, for example. So they meant a lot more. No, I think 15%. No, I think it's like, that's not the big problem here. It's the other things that I'm worried about. It's not the absolute number. 30%, as Matt said, is a major problem. Whether it's 10, 15, and Trump, it's midterms next year in the US. So, Trump is going to be, the tide will be going out for him. And as you said, there's a bit of a delay stalling tactic here.
Yeah, but do you know what? If you look at the registered voter sentiment, even though I've forgotten the right term of phrases, but even the sentiment towards Trump is extremely low. The sentiment towards the Democrats is even lower. So it's not like they have any.
Yeah, there's no viable alternative. Yeah.
No, it's like nobody likes Trump, but they trust the Republicans more across all of the factors in government more than the Democrats. So I'm not sure how the midterms are going to go. It's a really weird situation that we're in. But Mads, I mean, kind of stay on the European tip and stay in our world. What does this mean for founders? Is there anything that we should be thinking about doing differently? Worried, relieved? What do you reckon?
Back to what Lomax always says, heads down and build. And I think actually 10, 15% we can live with. If you're a pure play software company, this shouldn't change too much for you. If you are a mixed mode software and hardware, you got to think about how you procure and what your supply chain looks like. But even so, if you're in B2B, 15% on import, it's not 15% off your revenue, right? It's 15% off cost. So you can probably work that into your supply chain somehow. If you're a pure play hardware player, if you do consumer hardware, it'll be really difficult. You're going to have to think about moving your manufacturing to the US, or at least the assembly and kind of the final parts.
Interestingly, we have chatting to a US hardware founder the other day, talking about procurement of key critical items for their supply chain. Still much cheaper to get the stuff outside of the US. A lot cheaper. Even
well, this is where I think we're going to end up. I think there's going to be lots of head nodding, love affairs with Trump, lots of sycophancy. But the reality will be that the rest of the world will be looking at each other to be more insular and to manage their own supply, manufacturing, energy. My personal take is there is a bit of a delay tactic. Sure, yeah, smiling at each other's faces, watching von der Leyen's face as Trump was talking about windmills was quite
well,
hilarious.
I think when you watch the leaders sitting, when you watch Starmer and von der Leyen sitting there next to him, they're just like, how the F do I get out of this meeting without, like a Zelensky style thing?
Yeah, and when
Just
Trump
on
was
edge,
banging on
edge.
when
It's
he
like-
was going on about Sadiq Khan, and then Starmer's like looking around the room, going, "Well, he's a friend of mine, and he's a very bad mayor for London." I'm like, "Oh my goodness!" Yeah, so I think they're playing it perfectly. Lots of love. Who was the guy that was in the Oval Office who was just like absolutely blowing hot air up Trump's bum? It was one
Mark
of the big
Rutte.
Yeah,
Mark Rutte, head of
brilliant. Just like, I
NATO, yeah.
love you. You're amazing. Everything's amazing.
He got sick because he was doing it in text as well. Yeah, exactly. Yeah. Anyway,
Oh,
There is a longer term play to this. I mean, I think short term, it's pretty clear how this is going to pan out. Longer term, what's going to happen? And I think, look, we've sort of been able to tell ourselves what in retrospect were some lies historically, right? That it was fine to cut our defense budgets down to sub 2% because it didn't matter because the Yanks would come to our rescue. Well, now they have. They've just also sent the bill. Okay, so that strategy doesn't work. That's quite an important lesson for us. And I think that will change how we act over the next decade or two. And it will mean that when this is litigated, renegotiated, down the line, we're going to have a different position, a different posture. I think that will have a ripple effect through the technology sector. As you always point out, Dan, so much of tech started with defense. And if we have more defense investment in Europe, much more of that will be funneled to European companies. That'll drive tech, that'll drive innovation. And I think that will create more great homegrown companies that we can rely on. So I do think it will, long term, hopefully help to shift the balance of power. I certainly think that's a viable scenario.
yeah. I bang on about it. I know I'm a party of one on this, but I do think defense and resilience and the broader layers of the onion are going to do wonderful things for Europe. I absolutely passionately believe that. So I'm going to stay with that upside optimistic view, but staying with AI because Mads, this is your AI corner, my love. It is time for AI corner. We've got loads of, the docket is full, and also wonderfully lots of German amazingness. So we've talked about Anthropic. They're looking at a $5 billion fundraise. For context, they only raised 3.5 in March. So this is like another massive quick cycle, but as you've already talked about, not crazy hype stuff. There's a lot of fundamental growth in that bucket too. Germany is crushing it in so many ways. This week, they're celebrating its largest ever AI exit. I'm going to say this wrong, but Cognigy. We're going to go with that. Plus N8N, the open source workflow automation tool they're looking at a $1.5 billion valuation. So that's great for Germany. Over the pond, OpenAI is still shipping a gazillion features a week, the latest being study mode. But Mads, let's start with Anthropic. 5 billion. That's more than most European countries' entire VC funding. What does this buy them? What are they doing?
Oh, as you said, it's not that long ago they raised a $3.5 billion round. And that was in the context of them hitting that beautiful $1 billion ARR level at the turn of the year. Now, remember, that's the same number Figma has just gone public with. So 1 billion in ARR, that quickly grew to 2 within a few months, then 3, and then 4 in May. We suspect they're at the $5 to $6 billion ARR level now. And in the context of that, $170 billion valuation, which is what they're reportedly gone out at, doesn't sound completely crazy. That sort of puts them around the 30x multiple. So it sounds plausible, especially considering that they could be a $10 billion run rate by the end of the year. What are they selling? How can they get there? Why are they so popular? Well, let's put this and let's juxtapose this with what's come out of China. We've seen Moonshot's Kimi K2 model. We spoke about that a few weeks ago. Since then, Alibaba launched their new release of Qwen 3, and they've launched a direct competitor to Claude Code, that incredible tool that Anthropic has built for coding. Alibaba now has a completely open source alternative that's really, really good. And it's priced at 22 cents per million tokens versus the $15 you pay Anthropic. So that's 1/68th the price. Yet Anthropic keeps growing. Why? And this is sort of back to what we think is the enterprise reality of the large enterprises looking at this saying, there is so much value in these AI tools. To use them, we have to send our data to somebody else, at least today. And so we can either send that to a US firm located in California, or we can send that to China. Just no way, even if it's cheaper. But of course, the question becomes, well, Alibaba's model is open source. And once folks figure out how to rig that, it's actually not that hard and set that up locally. Could that start to threaten Anthropic's margins? And this is the big game of chicken everybody's playing right now. So far, doesn't look like it's slowing down Anthropic or OpenAI in any meaningful way. But are we going to see an impact at some point? Most people expect so.
It would just make absolute logical financial sense if you can own the stack and have the same functionality that at that 1/60th of a price point. It just seems bloody obvious. But Lomax, tell us about this kind of great German unknown Cognigy, which no one's ever heard of.
Yeah, it's a terrible name. And actually, both German companies that you mentioned, NA10 as well, it's also a terrible name. I mean,
Yes.
at least they can deliver numbers, it seems. But someone needs to have a chat to their, branding.
Yeah, the brand and
department.
marketing department need a chat.
So Cognigy is a
Is
bit
it
of
Cognigy? Sorry.
I don't know. I mean, let's just stick with that. So firstly, it's a great result. It's $1 billion exit for a European tech company. Another overnight success story, years in the making. So founded in 2016 in Düsseldorf. The company has been acquired. They raised Series A, Series B, Series C, $170 million, kind of general, kind of standard VC trajectory. It's in, it's a boring company, as in, in a way, it's working on call centers and support centers and customer support. It's not sexy. It doesn't grab headlines. Maybe that's why, it has a boring name. It's sold to a company with an equally kind of bland name, which is NICE, which is a publicly traded software firm. Yeah, headquartered in Israel, actually, which is focused on the AI-driven, CX, basically, so customer experience and compliance software. So the takeaway here is great to see $1 billion exit. We had the $33 billion exit with Wiz earlier in the year. Now we have a slightly European, smaller version of that. And this company has built, a solid business, and it's a great exit for the VCs and the founders involved. So good luck to them, and the money will be recycled. Good news story.
Yeah, loving it. And a good European news story.
Good European news story. It's a good example of the fruits of AI being born in areas that is not, you asked about coding and vibe coding and engineering earlier. This is not, eating away at engineering. It's eating at sort of back office,
piece.
White collar with a small W and C jobs. So yeah, for sure.
Is there more to come? Is Germany now the AI powerhouse?
I think it's certainly one of them. I mean, we've seen some really interesting things come out of France with Mistral. Lots of great success stories coming out of the UK. And we've seen some great success stories coming out of Germany as well. And I guess it's the thing we sometimes forget, which is, Europe is not just like a kind of one central Silicon Valley thing, everything gathered. We've got all these different hubs, and maybe that's part of our strength.
Well, let's have some in the UK, please.
No, Wave's done well. I mean, you've seen some companies, really get off to great.
11 Labs. Yeah. Wave's the only company. Wave raised over $1 billion in one round last year. There's stuff happening.
Yeah, baby. More of those. See, there we go. Now we're back to upside. So,
well, when you compare the UK to Germany, then I'm happy. All day long I can sit here. But it's when you compare it to the US that sometimes I feel myself on the back foot a bit more.
Yeah, sure. Although I do believe with a lot of this stuff, and we had this chat yesterday, Lomax, a lot of this stuff is inertia. Sure, there's the volumes of cash, and that's just blatant obviousness. But I do believe there is a period of inertia.
One thing I would say is actually it's funny. Because of the hugeness of the numbers that we've seen in the last 2 years in the US, or the last 12 months, Scale AI, 15 billion, Wiz, 33 billion, Windsurf, 3 billion after about 10 minutes or whatever it was, 2.4. Because, you've seen these numbers go, I mean, again, Wiz was 33 billion in 4 or 5 years, very short amount of time. The expectation has moved so high that when something like this, like $1 billion cash exit happens in Europe, you're kind of less excited about it. But if we were talking about $1 billion exit, 2 or 3 years ago in Europe, we would have been I would have been jumping out the window.
And
probably.
Don't do that.
These are actually, I would have flown to the coffee shop below. I don't know. But my point is, these are not insignificant numbers. And, if you look at, I think European venture is on track to raise like a measly 10 billion this year. And so you need the money to be coming out the other side. I think European venture exits are only kind of 15 to 20 billion a year. So you've got one company just delivering 1 billion, So I think it's great to see. We had Oxford Ionics sell for $1 billion 2-3 months ago. Again, we were excited about it, but we weren't that excited about it. I mean, I remember when, DeepMind sold for 450 million, whatever the number was, 10 years ago, and that was literally for 8 years. That's all anyone could ever talk about. The fact that we're getting a bit more immune to these things happening is a good thing. Although, it doesn't help when the US is pulling out such, the bar moves again, the goalposts move. We get to $1 billion, now it needs to be 10 billion.
Well, this brings me on to my last question for you both, which is, are we just the US's incubator? We're going to talk about Project Europe in a second, which is I think a really interesting, positive topic to talk about. But is that, and are we just an incubator for the US? I don't know if we're just feeding Silicon Valley. Mads, if you want to start that one.
I think that's down to us. I mean, we've talked about the issues around listing companies. We've also talked about just today how there was this idea that everything had to be M&A and private markets because public markets weren't paying up. Well, guess what? Figma kind of shows a different story. Then we've been talking about how firms can't IPO in the UK anymore because there's no capital. And we've talked about what needs to happen there. I think some of this is down to us. We need the capital markets reform. We need to reform the way investments are made. We need to make sure the money is there. We need to reboot public markets. And then I see no reason why some of these companies couldn't go down the IPO route instead. I do hope the market is swinging a little bit back. Let's not forget, private markets is an extremely expensive way to access these companies at the late stage. Okay, so when you have a seed or a Series A stage startup, that's not going to IPO. That requires the specialists and venture capital, of close collaboration with founders as you build the business. But once you get to $1 billion in revenue or $2 billion in revenue, okay, you don't need growth investors sitting on 2 and 20 managing your investment. It's a much cheaper way to access capital through public markets. You just need to design the system so the capital can find its way there to the stock exchange, right? So you need to make it not too onerous on the companies to IPO, and you need to make sure that the capital is actually not disincentivized from trading publicly. It'll be a cheaper way to access the capital, and so I'm convinced that's the way we have to go back. So I think you solve those problems. You'll solve exactly the issue you talk about.
I saw some of the chat search results from OpenAI, which kind of pricked my ears up. When you scratch underneath the story of that, there is a toggle in ChatGPT that can make your searches public or not. So I think people have to be very mindful as to how they use LLMs, but I did see some searches appear as I was looking at study mode. And Mads, I don't know if you've got any notes on study mode. I know that OpenAI are launching a gazillion products every 10 seconds, but what's happening with study mode? What is it?
I think I was most excited about when the ChatGPT was launched publicly back in 22 was this idea of how it can transform education. Because for eternity, education has been a mark of privilege, right? You go back in time and kind of the riches that they had their own personal tutors and that was the way they learned. And so today we have universal education, but there's still a sea change between folks that are more privileged and folks that are less privileged in this space. And I think with LLMs, for the first time in history, we genuinely can provide a personalized a tutor for every child, for every subject. And I think it's so exciting. I think it can liberate humanity in a way that I almost can't think of anything else that could do that to the same extent. And so I think study mode is just a really exciting advance towards that. Now, this is probably not going to be the huge moneymaker for OpenAI. I mean, education might be sort of a $7 trillion, global spend, but they may not be able to monetize it in that way today. But I still think it can be transformational if we implement it correctly in education.
I saw another, I think it was $1 billion deal. I saw an investor buy or invest in an edtech business this year. It was a mega edtech deal, and he was effectively trying to work out how to convert all of the material into AI tutors. So I'll find out more details on that, and we can catch up on that another day.
One of the things that, so first of all, I think this is fascinating for the category of edtech as a whole, because it's like, in a way,
for context, if people don't know, is an extremely unloved, unsexy area for venture capitalists.
well,
I think
traditionally it's been very, very hard. I mean, I give you, like, in learning Portuguese, for example, I now use ChatGPT. I don't pay for Duolingo anymore, right? So that's an interesting, I run my own exams that I do with ChatGPT as an example. So it sort of pays into what we've been seeing, which is that for the first time, like OpenAI, what OpenAI does can really, really affect what you're looking at as either a founder in terms of what to build, or in terms of an investor, what to invest in at the early stage. Because you could, we're going to invest in this vertical, whatever. So what happens if OpenAI move into it in a year's time? Is that going to be a problem? Well, ChatGPT is going to come and just wash this thing away. And, that's very, very too much of a simplistic overview there, but it is something to consider.
There is also, I mean, maybe this leans into the edtech piece, but Europe has to lean into what it does well. So what works for Europe, Mads? How should we be thinking about AI, and what should we be doing with AI? And I know that we talk about this application layer and edtech and that piece, but how else do you think about this?
Just the obvious, really. We should compete where we can win. And it turns out that we can, in applications, we really can compete and we can win, as we've seen with Cognigy and with some of these other deals that have happened. I think Europe has got a lot of strengths in regulated industries. We know there's a lot of compliance and figuring out how to navigate that. Workflow automation, what we saw with N8N is another one. So, focus where we can win, of course, which is an obvious thing to say. But I think that is what we should do.
Yeah, and as we are now opening, as the application layer is obviously proven, open, running, going, I think this is an exciting time to be alive for founders globally. And obviously Europe is going to be a massive player. We have all the talent doing incredible things, which then very neatly ties into what Harry Stebbings is doing with Project Europe. And I'm a big fan of this project. I think, okay, it's small numbers, it's batch one, it's only 6 startups, but this is just such a fabulous thing. And so for Harry and Kitty, who's running the show there, I think this is brilliant. So for context, so Harry Stebbings, the podcaster turned VC, announced his first batch of Project Europe investments. That's 6 teams, and it looks and smells a bit like the Teal Fellowship or Y Combinator, and building that in Europe. They're investing 200,000 euros into startups focused on hard technical problems. Sound familiar, Mads? Not just another AI wrapper. This is the thing that I feel slightly conflicted with, but they're only investing in founders under 25 and then placing in the who's who of European tech to mentor, advise, and support, like Matty from 11 Labs, Stefan from Synthesia, Sebastian from Klarna. Assuming they have the time. I don't know how that's going to work, but good for them. Now, this is designed to keep European talent in Europe. Again, going back to are we the incubator for Silicon Valley? Not sure how that's going to work. I think it's freaking cool. I think we absolutely need to celebrate it. But Mads, I want to start with what it is and the chosen verticals, which smell and sound very similar to ours. It's not broad like YC. What are the verticals? Does this expose his thesis on European venture? How does it all fit together?
I think it absolutely does. So 6 companies selected, as you say, not consumer, not social, not SaaS. It's kind of real deep tech with security. And he's in defense and robotics with Zero Industries, which is around autonomous drones. Phylon, which is sort of general purpose robots. You've got some brain computer interfaces out over at Bionics, which is kind of mind-controlled robots. Sounds very sort of sci-fi and exciting. You've got some cybersec with Hackthron AI and Hiker. And we've seen how there's been some incredible exits this year in cyber, right? We're going to talk about another one today, I believe. So these are cool spaces, and then kind of the mobile infrastructure at Celify. What this tells us is that he is betting on European technical depth. So it's not just business model innovation, it is deep tech. 4 out of the 6 are really about hard tech requiring serious engineering that's playing to these European strengths in robotics and industrial and defense. And you could to some extent say it's almost sort of the anti-YC. So it's really deep tech over quick flips. And this is stuff that could take a decade to build. So I'm excited that this is where they've doubled down.
then we need to see the growth capital, right? It's all very well having an accelerator, and Lomax we're going to dig into, is it or not, because I want to lean on you for that. But obviously we then need to stop the brain drain. We then need the growth capital and the follow-on players to lean in. But Lomax, you know this world. What's your initial reaction?
No, I think it's a high level, very cool. Like, you're getting, high profile people to give their time. I think, look, I think there's a general catch-22 with accelerators at the beginning, which is that how do you, like, why would the best founders join an accelerator? Like, the whole point, the irony being, it's like the best founders don't need acceleration. You know what I mean? So that's always been, and most accelerators have failed to overcome that, in my view, right? Obviously, Y Combinator.
Interesting.
Yes, of course. I think that's, I think there's tons of accelerators that don't deliver any value. They don't attract the best entrepreneurs and founders, because I think, I don't know, I have a very simplistic view on this. Like, some of the, entrepreneurs we back, they're so ambitious, determined, focused, and why do I need an accelerator? Yeah, now, of course, I don't want to get into that debate. What I'm saying is these things are very, very hard to pull off. Y Combinator have done it very well, and EF in Europe, actually, which does focus on deep tech, I think is starting to see, the fruits of its work now. I think EF now have a 100 million revenue company in each of its cohort, and you saw the numbers from Clio, which was in one of their first cohorts, Clio AI. Like, I think the EF project is working. But if you look at YC and EF, they built in the shadows a little bit at the beginning, and it took time. YC started in 2005, didn't really become a big thing until 2012. EF started in 2011, 2012. And, only now are you starting to see the big results come through.
But they have become an American incubator. I love EF, but they're all Delaware companies.
No, sure, but fine. But I'm not like criticizing. The point I was making was these things normally take a long time. What I think Harry's trying to do with Project Europe is try and short circuit that by, having his position in the market, bringing in these amazing people as mentors, and kind of almost like short circuiting or creating a shortcut to success. I think, look, the move to hard tech, some of these hard tech companies, I mean, most of them are still software companies, to be fair, but these deep tech companies, is that this stuff takes time. I've invested in quantum computing, hyperspectral, like these things take many, many, many years. So you need to have strong stomach for this stuff. Now, Stebbings clearly has a strong stomach for many, many things, and clearly approaches life in a sort of marathon format, it seems. So he needs to be aware of that, which clearly he is that investing in these kind of companies requires you to be super patient, requires lots of stuff goes wrong. The go-to-market takes a long time, and you're often asked to write quite big checks with no commercial validation whatsoever. Yeah. So you still need to get these companies to raise the 20, 30 million Series A when there's still very, very little commercial traction for the really more extreme deep tech companies. So this takes time. Look, I think it's great. I think, these, we'll see how they get on. I mean, one thing they will need to deal with is signaling risk. Like, unlike YC and EF at the beginning, where the companies were kind of building a little bit more in the shadows, these companies are now at the front and center.
Yeah, there's a big PR game, isn't there?
So suddenly every little knock they have, or every little setback they have, which clearly everyone has a setback, then that's going to be in the public limelight. And then you end up with this thing of signaling risk. It's like, well, is Harry going to do the seed round with his fund? Because he has one of Europe's biggest seed funds, no? So if he doesn't, what does that mean? Et cetera, et cetera. I'm sure he's figured all of that out, because in our industry, as we talked about before, when Index comes down to do a seed round, the biggest question everyone asks is, will they do the Series A or not, as insiders, because they have the information. The same thing in a small level will apply to this. But look, smart people working on big problems with smart people around the table, I think it can only generally lead to good things. But my takeaways is this will take a much long. There's no quick fixes here. Company building takes time.
Yeah. All those overnight successes, as you were mentioning earlier, are all in the decades. They're not measured in years, but. Apart from if you're Anthropic or one of the foundational models, perhaps. But Mads, can we stop the brain drain?
There will always be a move of talent going both ways. I think probably recently we've seen perhaps a little bit too much going from Europe to the US. Can we turn it back? I think it's down to us, how ambitious we are, how fast we move. Am I hopeful looking at some of the European governments today that we are as ambitious and aggressive as we should be? Probably not, but that doesn't mean it couldn't change. I mean, things change all the time.
I was surprised at how few companies. I thought it was a mega brain drain, and I am going to dig out the numbers, but it's not as crazy a bunch of either people that do subs or HQ in the States. It's sub 10% as it stands. So I guess it depends on which ones go, but it's not the crazy brain drain that everyone perceives it to be. What else would you dig into here before we move on to deal of the week? Any other aspects that you'd bring to life?
I think it's exciting. I applaud it. I wish it all possible success. And yeah, let's hope it succeeds.
I think how he's leveraged his brand and his market presence, I think it's just bloody genius. And Kitty seems like a really smart cookie. So I can't wait to see them out in the field, and I will be sitting on the sidelines cheering along and supporting as and when I can. So deal of the week, my man, kick off. So Palo Alto Networks. So tell us a little about what's going on there.
So we talked about Wiz being acquired by Google earlier in the year, and this is another behemoth cybersec deal. Palo Alto Networks, they're acquiring CyberArk for $25 billion. Now, CyberArk was already a public company, so it's not an acquisition from private or from VCs, but it's still just a massive deal. And it does kind of show how much cash there is in cybersec and how important an area this is. Kind of CyberArk is probably unknown to many people. What does the company actually do? But to some extent, you can say they have the keys to the kingdom. They manage the privileged accounts, sort of the admin and root accounts that can do anything. And if you have a large enterprise, you've got database admin passwords and servers with root access and accounts that can transfer millions of dollars. And so these aren't your regular employee logins. These are the accounts that can enable you to delete entire systems. And so banks and hospitals and manufacturers, they use them to secure their most critical assets. And why don't you just use the access management tools in your cloud provider? You have them at Google and AWS and Azure. But the reality in enterprise is that they have multiple clouds, and they still have a very large proportion of on-prem and legacy systems. And so CyberArk just manages everything from mainframes to Kubernetes. So you can sort of call them the Switzerland of identity management, if you will. One neutral platform that connects everybody. So that's the reality of why they're worth $25 billion. And we can go into more about Palo Alto's acquisition spree. They've been acquiring a lot of things. This was probably the last sort of major piece of the puzzle for them to complete the stack. We can talk about what's happening with the AI future that may be even more interesting. If you think about a future that becomes more agentic, there'll be more autonomous systems requiring access to other things. Well, who's going to manage, who can access what? And so CyberArk could be a key part of the puzzle there. And that's probably another reason why it's got such a nice price tag.
Yeah, I think that's bang on. The non-human access, I think, is going to be a mega deal. My deal of the week is Project Q. So another German. I've got a bit of a German love affair this week. Another German startup. They've made the cut. So the German battlefield integration software startup Project Q have raised 7.5 million euros this week, led by Project A. So all power to you, team. I hope you're a massive, raging success for Germany. Loving your work. Gentlemen, what a pleasure and a gift. I'll catch you next week.
See you in the next one.
Upside.